Did you know most billionaires pay a lower tax rate than their secretaries? Today, I'm going to show you exactly how they do it. Ever wonder why you're paying 30% of your income in taxes while Warren Buffett admits he pays just 17%? It's not because they're breaking the law, it's because they understand something about the tax code that most people don't. After spending years researching tax strategies used by the ultra-wealthy, I've identified the 5 key methods they use to legally minimize their tax burden. And no, none of these involve illegal offshore accounts or shady tax havens. Let's start with the most powerful concept in wealth preservation. Tax isn't about how much you make, it's about how you make it. The entire tax system is designed around this principle. Think about your paycheck for a second. When you're an employee, taxes get taken out before you even see the money. You earn $100 and immediately $30 disappears to taxes. That's called income tax, and it's the highest tax rate in America, reaching up to 37% federally, plus state taxes on top of that. But rich people structure their finances differently. Instead of earning a salary, they build wealth through appreciating assets. Let me explain what that means. Say you invest in a company stock or real estate. As those assets grow in value, you become wealthier on paper, but critically, you don't pay any tax on that growth until you sell. This is called unrealized gains, and it's the first pillar of tax avoidance. Let's use Elon Musk as an example. In 2021, his wealth increased by about $121 billion as Tesla stocks skyrocketed. How much tax did he pay on that $121 billion? Exactly zero. Because he didn't sell those shares, there was technically no income to tax. But wait, you might be thinking, don't rich people need cash to live? They must sell eventually. That brings us to the second strategy, borrowing against assets instead of selling them. When Elon wants to buy something, even something huge like a $50 million mansion, he doesn't sell Tesla shares. Instead, he goes to a bank and gets a loan, using his shares as collateral. Here's why this is brilliant. Loans aren't considered income, so they're completely tax-free. The bank is happy because they have Tesla shares as collateral, and Elon is happy because he gets cash without triggering any taxes. Meanwhile, his Tesla shares continue appreciating in value. This strategy is called buy, borrow, die in wealth management circles, and it's incredibly effective. The ultra-wealthy can live lavishly while technically having little to no income on paper. Think about the math. If Elon sold $50 million in Tesla stock, he might pay $20 million in taxes. By borrowing against his shares instead, he pays maybe 3 to 5% in interest to the bank. That's just $1.5 to $2.5 million. He just saved over $17 million by borrowing instead of selling. The third major strategy used by the wealthy is strategic loss harvesting. The tax code allows you to offset your investment gains with investment losses. Rich people actively look for opportunities to sell investments at a loss, specifically to offset gains they plan to realize elsewhere. For example, if a wealthy person needs to sell $1 million in profitable investments, triggering $200,000 in capital gains tax, they might look through their portfolio for underperforming investments they can sell at a $1 million loss. These losses cancel out the gains, and just like that, zero tax owed. But it gets even more interesting. After selling that losing investment, they'll often buy something very similar, but not identical, that would trigger what's called the wash sale rule right away. This way, they keep roughly the same market position while capturing the tax loss. The fourth strategy is the stepped-up basis loophole, which is honestly one of the most powerful tax advantages in existence. Here's how it works. When you die, your heirs receive your assets with what's called a stepped-up basis, meaning all the gains that occurred during your lifetime are never taxed. Let's say you bought Amazon stock for $10,000 in the early days, and by the time you die, it's worth $10 million. That's a $9,990,000 gain that would normally be taxed. But if your children inherit those shares, the $9,990,000 in gains is completely wiped out for tax purposes. They can sell immediately and pay zero capital gains tax. This is why the buy, borrow, die strategy ends with die, because death eliminates the tax liability completely. Your heirs get the assets tax-free, and the accumulated gains are never taxed by anyone. The fifth major strategy is using business structures to transform personal expenses into business deductions. When you're an employee, things like your car, meals, travel, and even your home office come out of your after-tax income. But wealthy people often own businesses, allowing them to to run these expenses through their companies. Let me give you a concrete example. Let's say you're an employee making $100,000 per year. You buy a $50,000 car, but you pay for it with after-tax money. Assuming a 30% tax rate, you had to earn about $71,500 to have $50,000 left after taxes to buy that car. Now, if you're a business owner and can legitimately use that car for business purposes, you might be able to deduct the entire cost as a business expense. This means you're buying the car with pre-tax dollars, effectively getting a 30% discount compared to the employee. This principle applies to countless expenses: business travel, which might include luxury hotels and first-class flights, meals with business contacts, home offices, technology, and more. The wealthier you are, the more you can structure your life around your business interests, making a higher percentage of your consumption tax deductible. But wait, there's a challenge with these strategies. What if you're not already rich? How can you start using these techniques to build wealth? Let's talk about that. While you might not be able to implement the full buy, borrow, die strategy right away, there are versions of these tax strategies that work at nearly any income level. First, prioritize investing in tax-advantaged accounts like 401ks, IRAs, and HSAs. These allow you to invest with pre-tax dollars, giving you an immediate tax saving. Second, hold your investments for at least a year before selling. Third, if you have any kind of side business, learn the legitimate tax deductions available to you. Many everyday expenses might be partially deductible if they have a legitimate business purpose. Fourth, consider investing in real estate. Even middle-class investors can access significant tax advantages through depreciation deductions and the potential to live in a property for 2 years to exclude gains from taxation. Now, let's address the elephant in the room. Is all this ethical? Should the tax system allow these strategies? That's a complex question. Defenders argue that these rules incentivize investment and economic growth. If we taxed unrealized gains, for example, entrepreneurs might have to sell off pieces of their companies just to pay tax bills, potentially losing control of their businesses. Critics point out that these strategies are primarily available to the already wealthy, creating a system where effective tax rates actually decrease as wealth increases. This runs counter to the progressive taxation principle that those with more should contribute proportionally more. What's clear is that these strategies are perfectly legal under current tax law. The wealthy aren't breaking rules. They're just playing the game as it's designed. They have teams of accountants and tax attorneys who help them navigate these complex waters. And that highlights another advantage the wealthy have: access to expert advice. When you're dealing with millions of dollars, spending $50,000 on tax planning services makes economic sense. The average person might save a few $1,000s at most from complex tax planning, making expensive advice impractical. Let's zoom out for a moment. The strategies we've discussed are symptoms of a broader reality. Our tax system primarily taxes income, not wealth. If most of your financial value is in appreciated assets rather than regular income, you can accumulate enormous wealth while generating minimal taxable income. This is why proposals for wealth taxes or unrealized capital gains taxes keep surfacing in political discussions. These would fundamentally change the game, making it harder to accumulate vast wealth without paying taxes along the way. But until such changes happen, the current system rewards those who structure their finances around these principles. Remember, building wealth isn't just about how much you earn, it's about how much you keep. And minimizing your tax burden is one of the most consistent ways to increase how much you keep. Let me leave you with this thought. The tax code isn't just a set of rules to comply with. It's actually a set of incentives that guide behavior. The government uses tax breaks to encourage certain activities, like investing for the long term, starting businesses, and putting money into real estate. By understanding these incentives, you're not just saving on taxes, you're aligning your financial decisions with the wealth-building paths that have been deliberately built into our economic system. The strategies used by the ultra-wealthy might seem out of reach, but the principles behind them can be applied at almost any scale. The key is to start thinking about taxes strategically, not just as something you deal with once a year when filing returns. So, which of these strategies will you implement first? The sooner you start applying these principles, the more wealth you can preserve over your lifetime.